Good stuff. So I think Ollie's covered my intro anyway, but let me share my slides and we can dive into it. So yeah, in today's session, I'm going to do just 2 minutes on what FounderCatalyst does. I think I know virtually everybody on here anyway, so I won't waste too much time on that. Talk about current market conditions, so what we're seeing. We've got some interesting stats from Bowhurst a month or two ago. And there are some interesting things on the horizon as well that I can cover that I think may change investors' appetite. And there's also a timing thing as well, so we can cover that. Then we'll dive into, really, this is just the meat of the presentation, is around what investors look for. And ultimately, investors are looking to de-risk. They want to put in their money. They want to get the best deal possible, so own as much as your company as possible by negotiating on valuation. But the next thing they want to do is understand and minimize, understand how you're minimizing the risk in their investment to ensure that they have the best chance of a good outcome. And I'll talk through a mind map of how myself and lots of investors think, and then 3 tips for obtaining funding in this kind of market. So these will be really, really quick, kind of aid memoirs if you haven't done them already. So conscious of time, we've only got half hour. We also want to cover a few questions, so I will rattle through the next section and then get on to the detail. So I think everybody knows, but FounderCatalyst is by far the most cost-effective way of doing a funding round in the UK. In terms of what we do, 4 things. So we offer a whole bunch of free stuff on our website on a page called Free Stuff, which is great. Things like employment contracts, advisor agreements, cap table modeling tools, and stuff like that. The second thing we do is help people get the absolutely vital SEIS and EIS advance assurance. We've got 100% success rate over the last 3 years, and we had our fastest response ever earlier in this week. It was 5.5 hours positive response from HMRC on that, which is pretty awesome. The average still being 2 weeks, but I'm going to crow about that awesome response anyway. Funding round legal, so we do every legal piece of paperwork from the term sheet at the front end through to the share certificate. We do shareholder agreement articles. We've got cap table management side, investor intelligent data room where you share your documents, and online signing and all that kind of stuff. And then finally, we make intros between our customers and potential sources of funding, all for 1,500 quid fixed price. And to give you some idea, one of our customers 2 months ago raised £2.7 million using FounderCatalyst and saved themselves. We were at 10% of the price of the next most cost-effective way of doing that. So we're ridiculously cost-effective. Anyway, enough jibber jabber. Let's have a look at the current market conditions. And I think this slide from Bowhurst pretty much says it all. So over the last few years, everybody can see the kind of the best quarter ever was kind of Q4 2021. Q4 2021. And we have fallen a long way since there. And a few things have changed. If you look at the macros since then, December 2021, for example, interest rates were at a dizzying 0.1%, and they peaked at 5.25%. I think they're still at 5%. So we're kind of in that position where actually cash is really expensive. If you've got interest rates at 0.1%, then there's not really any impact to you kind of borrowing money and investing it, and you can be a bit more, you can carry lots of debt because it doesn't really matter because it doesn't cost you a lot. When you've got interest rates at 5.25%, actually cash is really expensive, and then people rush to invest that. Don't rush to invest it quite so quickly. You've got to have a really compelling opportunity. So I think we are in, every indication is that interest rates are going to drop over time. Which is good, and that is a really good leading indicator of an appetite will return to investment, probably. You've then got inflation, which again is painful for everybody. One of the challenges with angel investing is it's a very illiquid asset class. So if I put money into a startup and it's in there for 10 years, and I've got no control, by the way, once I put money in, it's kind of, I'm along for the journey. If I've got money in there for 10 years and inflation is currently running at 10%, that actually inflation whittles away at that cash whilst it's sat there. So the returns from the startup have to be pretty extraordinary. So when inflation's high, everybody just gets nervous anyway. Everybody kind of clamps down on spend, including investment spend. I think we saw a peak briefly of roughly just under 10%. CPI, and now this has settled down much closer to 3%, which is much more palatable. It's still a little above where it should be, but we're seeing that dropping over time. So again, that's a leading indicator. Once inflation drops, everybody kind of gets a lot less jittery on the market. As long as there's not a more war in the Middle East, which will obviously that will disrupt everything, and God knows what that will mean. One really interesting and important thing to remember about this graph. So the massive peak you saw, from 2020 all the way through to early 2022, that peak was driven, the pre-seed, pre-revenue, pre-seed and seed kind of level. There was a blip there, so there was an increase at those kind of levels. But the huge increases were at kind of VC, scale up and growth kind of capital level. So the bulk of this amount, so the yellow bars are the amount raised, the bulk of that was actually due to some massive 500 million billion pound investments at the really high end of the market. So you saw some very big mega deals, and those mega deals quadrupled in size compared with the previous period. The amount of money that flowed into pre-seed and seed was actually much less. So there's a pro and con to this, but this bounce you see here is mainly down to massive Series B onwards in reality. The collapse is also down to, it's much harder to get money out of VCs at the moment. So the collapse that we see here is very largely at the top end anyway. So the peak was due to VC investment and the dippers as well. There's no doubt that pre-seed and seed investment has dropped in terms of the amount and the number of deals, but it's nowhere near as harsh as this chart would indicate. What we're also seeing, so at the higher end deals, and I'm not sure if this applies to anybody, but I'll say it anyway, at the higher end deals for VCs have really tightened up massively. So firstly, they're not, I think it's less than half of the money is being invested at the moment in the UK from VCs. So that's tightened up massively, which means that they are getting much more fussy about the deals that they invest in. So yeah, due diligence is taking longer, and secondly, the terms are much harsher as well. So back at the peak, there were there was more VC money sloshing around than there were decent deals to do. So there's that competition where startups can set the terms for the funding round, they can set the valuation, and if the VCs wanted to play ball, then they had to just accept the terms. The shoe is certainly on the other foot now, where in as much as there are lots of deals around and much less cash, and that means that VCs are driving the terms and the valuation. So even if deals are being done, they are at the old standard used to be 1x non-participating liquidation preference, which is very standard for a for a VC investment. It's relatively founder friendly. It's the most founder friendly liquidation preference you can have. That has now changed to 2x, and quite often 2x participating. I won't explain what that means, but it's that is very investor friendly. It basically means that investors get their money out first, and quite often twice, before anybody else earns from the transaction, which is very investor friendly. But that's just because the VCs have the upper hand in terms of negotiation. We're not seeing that at the bottom end. So in pre-seed and seed, like anybody pre-VC, the terms really haven't changed. And primarily that's because SEIS and EIS investments can't make use of liquidation preference, anti-dilution, down round protection, non-diluting shares. They can't have any of that. So the variables that an investor can use to beat up on founders are relatively low at a kind of under SEIS, EIS than under kind of non-SEIS, EIS investments. In terms of what normal looks like in the current condition, actually, this hasn't moved for 2 or 3 years for pre-seed, pre-revenue. In terms of the valuation, the average valuation is still roughly around 1.5 million. That's for pre-seed, pre-revenue. The challenge being actually closing a funding round without any revenue at all is getting much harder. Investors, even angel investors, are increasingly looking for traction. So 2 years ago, angel investors would routinely invest at a valuation of 1.5 million. They would, invest on the basis of a shiny pitch deck and a bright idea. Now, investors are being much more insistent on having some traction, whether that's revenue or at least an MVP built or whatever. So that is a big change. The average amount being invested has actually jumped quite a bit over the last few years. So I forget when it was. It was 2023. Time flies. 2023. I think the SEIS limit changed from 150 to 250, and actually the average amount being invested in the UK moved from about 160, 170 a couple of years ago, is now sat at 250,000 exactly, which is the SEIS limit. There is, in terms of the drop in interest rates and the change in inflation, there is one kind of forward indicator which leads me to believe that things will potentially get much better for startups fundraising over the next few months. So there's kind of two things actually that collide. So the first is before Labour came into power, they said they ring-fenced a bunch of taxes they wouldn't increase. So they said, we're not going to increase PAYE, we're not going to increase NIC. I think they did the same on corporation tax. So they basically, all of the really, really big taxes, they said, we won't increase those under a Labour government to give business certainty that Labour would be pro-business, which is all well and good. But they've also said they're going to increase the overall tax take and therefore, to cover increased spending. The problem with that, there aren't many taxes to go at because they've ring-fenced, they made pledges not to increase lots of taxes. The two really, really obvious taxes, ignoring non-doms for a minute, which I think is, it's going to be a rounding error in terms of the overall tax take. But the two big taxes they can increase are that they have not said are going to be ring-fenced and frozen, a capital gains tax and inheritance tax. So capital gains tax is currently 20% on virtually everything other than if you're an asset manager taking carry. I would absolutely expect CGT to increase. I think there is a really obvious disparity between how much capital gains tax and how much PAYE you pay. And if you're in a fortunate position, as I am, for example, I don't have to take any salary from anything. I don't need that. So I take all of my benefit out of companies via, if I can, the capital gains tax, because the CGT charge is much, much better than PAYE. So I can imagine that Labour it's one of the only taxes they can go at. So I think they'll increase it because it's one of the few taxes they can work with. But also I think they'll increase it because it is, Labour voters won't care about that. Most people can't benefit from a CGT increase. So I would see I can imagine a substantial increase in capital gains tax. The second tax to look at here is inheritance tax. And again, Labour core voters typically won't be too fussed by inheritance tax, though I think, the amounts the baseline hasn't increased for a while, so virtually everybody's going to kick into that at some point. But anyway, inheritance tax is currently an eye-watering 40%, I believe, and I would expect that to increase as well. So why am I focusing on those two taxes? If you take on investment under SEIS, EIS, your investors get get capital gains tax and inheritance tax exemption, which, funny enough, makes SEIS and EIS a beautiful asset to hold, because if I invest in your startup and you turn £10,000 into £1 million, for example,
Express,
then usually there would be a massive tax CGT bill to pay on that. Under SEIS and EIS, I don't have any tax bill at all to pay. So no matter what happens to capital gains tax, it is still expected that SEIS and EIS will be CGT exempt. And also, when you get to my age, you worry about inheritance tax to some degree, and I don't want all of my assets being taxed at 40% when I die. So actually, it makes sense for me to have a good proportion of my investments under SEIS, EIS, even if they haven't exited at the point that I die. All of those shares pass to my estate entirely free of inheritance tax. So I think those are the two very big taxes that Labour are almost certainly going to go at, and both of those, fortunately, are the two that are kind of covered and exempted entirely by SEIS, EIS. So I do think you will see an increasing focus on high net worths and ultra high net worths in shielding their assets from those two taxes specifically, and SEIS, EIS are a great way of doing that. The other reason I think we'll see an uptick is that we're just about to go into the golden period within the kind of yearly cycle of investment. The best time to fundraise as a founder is January, February, March. And the reason for that is investors are trying to use their end of year tax relief. So everybody knows they've got a tax bill and they want to use that. It's kind of use it or lose it. You can go 1 year back under SEIS, EIS, but people are using it or losing it on that 1 year back as well. So yeah, January, February, March are great. And April is also amazing because everybody's just then got a brand new tax relief. So they're like, I'm like a kid in a sweet shop every April because I'm like, oh great, I haven't been able to invest for a while, I'm going to invest now. So we are entering that January to April amazing period. It'll be really interesting to see what Bowhurst report on Q3 2024. I expect it will be a drop. You can see, and there's no, Bowhurst can't explain this either, but there's a really interesting one good quarter, one bad quarter, one good quarter, one bad quarter, and there is no reason to think that will stop now. So I expect Q3 may be bad, and then I expect we'll be seeing an amazing Q4. So anyway, that's my current view on market conditions. Let's quickly rattle through on how an investor will evaluate and select a startup. And this is a very wordy slide, and I'm not going to talk about all of it. But I guess the first thing to say is, when I look, and this is, every investor has a slightly different view of the world. Every investor should probably think through every item on this slide, but some naive investors may not think about some of this, I don't know, they may not understand the importance of patents. They may not really care that much about competitors. They don't really care about partnerships, whatever it happens to be. But broadly, every investor will think in each of one of these big blocks. But every investor will absolutely have a different priority and a different kind of ranking for what's important. So for me, I'm a investor in teams. If I think it's got a great team, they're well-rounded, they've got all the skills I need, they've had previous exits, and they're genuinely nice people, well, great. I'm much more likely to invest. If the team's shit, I'm just going to walk away, because for me, having a bad team is just not tenable for an investment. So every investor is going to look at this in a slightly different way with slightly different priorities. And it kind of depends on the business as well. More mature businesses will have a slight bias towards, exit strategy. They'll have already covered the tractions and proof points, hopefully. So it will be about, what's the financial forecast? How are they going to scale up and how are they going to exit? When you're investing at an early stage, exit strategies are pie in the sky, so most people wouldn't worry about it. Forecasts are kind of a finger in the air because you probably haven't got revenue. You don't understand your unit economics, so that would be ignored. So it's much more about what's the team? What does the deal look like? Is it a good deal I'm getting? Are there any competitors in the space? And what is the kind of overall proposition to the market? Is it really trendy like AI, or is it something that's a bit of a has-been, like, is it selling NFTs, which is they've kind of missed the boat by 2 years there. So for me, this is my thought process. Like I say, if I talk about my experience personally and the experience for lots of very early stage investors, team will be by far the most important thing. And I'll give you an example. I bumped into a founder once. I actually didn't see the founder. I saw the pitch deck first, and the proposition was amazing. It was a drone company that had drones that go across massive cornfields or wheat fields or whatever in America, or whatever crops in the UK, and it would automatically detect, based upon the crop type, what was wrong with the crop. So is it underwatered, overwatered? Does it need nitrates? Does it need herbicides or pesticides? Whatever it happens to be. And it does this automatically using AI, and then instructs the farmer, right, you need to put, I don't know, a ton of nitrates over this part of the field, whatever it happens to be, or you need to overwater this part for a couple of months. So it's just amazing technology, and I love the social good. We're in a world of food insecurity, and this, could have saved billions. I mean, it was just a lovely, lovely proposition. And I saw the pitch deck, and I'm like, I'm going to invest in this. This is brilliant. So I went on an intro call with a founder who was a complete idiot. He was, he just couldn't articulate the proposition. It wasn't just me on the call. There were a couple of other people. He was rude and abrasive answering questions. He didn't have any co-founders, and basically he could do the parts of the technology, but he couldn't absolutely take this to market. He shouldn't be trusted talking to customers, frankly. And I walked away. I just thought the team just isn't there. I think he had a plan to recruit a salesperson and a CEO, and I just couldn't bring myself to invest in that person. So I think that kind of identifies, and everything about the deal was kind of bingo. It was investor bingo. It was SEIS, it was low valuation. They'd built some of the tech, they had a patent, and everything was perfect, but the team just wasn't there. And I wasn't surprised. I've checked back on, I use this example quite a lot. I checked back on the company 6 months ago and they'd folded. They had gone into administration, which was no great surprise to me. So we can come back onto this in a minute in the questions and answers. I'm keen to get to that. But that is how I as an angel, will analyze your startup, as well as, the softer stuff as well. But mainly it's this. In terms of what this means for valuation, so valuing an early stage pre-seed, pre-revenue business is really, really hard. So this is the way I do it in my own mind when I'm looking for an opportunity. This is related to kind of comparables, Berkus, and scorecard valuation methodologies. Those are the only 3 ways you can really value an early stage business. You can't use things like DCF or the VC method. They're just not relevant because you won't have enough revenue to kind of do those calculations. But for me, this is how I do it. I look at what an average valuation for a pre-seed, pre-revenue business is. And the 1.5 million is from Bowhurst. They track every single funding round in the UK by stage, sector, geography, gender, you name it. And the average across pre-seed, pre-revenue is 1.5 million. I then apply I kind of score the business out of 10 by each of these yellow blocks here. And some will be a combination. If you've got a really great team, out of 5, maybe I'll give something 3 out of 5. If something's really, really bad, then they'll get a 1 or a 0. But ultimately, I take the score times my weighting for that individual element, and then come up with what that means to the pricing. And you can see in this case, there's a whole bunch of add backs and takeaways. So the team's great in this case. I think it's 1 out of 3. So sorry, the best score's 3. So this team is absolutely amazing. They've got, PhD, multi-exit founders. There's 5 of them. They've got sales, operations, CTO, everything's covered. It's perfect. So for me, that scores 300,000 as a bump above the 1.5 million. And you can see here, competition and defensibility. They might not have a patent. There might be a really strong player in the market or whatever. So they score very weakly there. And you can understand the methodology. That all adds up to a net change of 300, which means that I think a reasonable valuation for that business is 1.8 million. By the way, I'm not going to offer that to a founder. Valuations are probably the only thing that every investor in the world understands are important. Because of what I do for a living, I understand how to negotiate pretty much every part of a term sheet. Every investor, even the most naive, will understand that having a lower valuation gives them a higher percentage of the business and is within reason something you should fight for. So I'm not going to offer 1.8, but it's an indication for me mentally that 1.8 is somewhere I would be happy to land up, as long as I'm interested in the business, full stop. So tips for fundraising for the rest of 2024, and this counts for the start of 2025 as well. 2 years ago, your preparation as you go into a funding round could be relatively modest. That's changed. You need to have all of your ducks in a row now. If you look ill-prepared in any of these ways, then you will see investors walking away, frankly. So 5 ducks in a row, and I'm not going to explain each of these. I'm going to assume you know what they are. Firstly, you need a pitch deck. Secondly, you need a forecast. Third, you need SEIS advanced assurance. If you don't have that before a funding round, the same as everything else, really, it looks like you're ill-prepared for the process. The 4th item is a term sheet, a summary of the legal terms you're offering. And then 5th and finally, you need a valuation justification. And back in the day, I used to say you only needed the first 4. I think given the state of the market now and how hard it is to fundraise, by some mechanism, you need to justify your valuation. And we've got lots of valuation calculators on our free stuff page on our website. If you're later stage, you'll be looking at DCF and VC. If you're early stage, comparables, Berkus, and scorecard. So tip 1, get your ducks in a row before you start speaking to investors. Second, prepare for scrutiny. Due diligence now is much, much harder than it was a couple of years ago. So yeah, expect more questions, get your data room prepared, don't make people ask for stuff, have everything ready. We're seeing some investors do payment in tranches. So they're like, great, well, I'll invest 100K. I'll give you 30 now, 30 when you achieve milestone X, and you'll get another 40 when you go to market or whatever. So do not be overly surprised if that's the offer you get. Tip 3 very quickly is around using agile investment. So back in the day, this is how you do an old school price round, as they're called. It's time consuming, it's not agile, and it's big bang, which means if you're raising 500,000, you've got 100K committed, you've got to wait until you get the rest of the money committed. It's really painful. The world has gone agile. So, everybody now is taking money using agile fundraising, which allows you to take the first 100 and then drip feed the other 400, over a period rather than just doing a big bang. Obviously, you need your investors to be willing to invest in this way, but it's massively de-stress. It's the most elegant way of fundraising, and it's a massive de-stress for founders. Anyway, that was lots of talking and a brain dump, but I wonder if there are any questions at all.
Wow, thank you very much, Sam. Paul.
Morning. I just want to confirm I heard something right. Did you say back in the present? Did you say the average ticket size was 250K?
No, the average funding round, so everybody's tickets. So yeah, the mean amount invested during an SEIS pre-seed pre-revenue is just above 250. It's 251 actually.
Right.
Yeah, so that's not the average ticket size. That would be bonkers.
Right. I suddenly thought I was missing the mark on this one. And what would you say the average ticket size is, please?
It kind of depends. You see, I think the average is like the mean is about 25K, but there's a really, really big variable there. So we see single funding rounds closing with one investor putting 200K in or whatever. So they're either really, really big investments from a single investor, or you get a smattering of 10s, 20s, and a few 30s. So the average is 25, dragged up by the fact that some of our funding rounds are outliers, as in one investor. It's usually an investor that's going to become an advisor that wants a meaningful chunk of the business.
And then I have one more question, if you don't mind. You talked about the agile funding round versus the fixed price round.
Price round, yeah.
Yeah. So obviously agile's better for me because it keeps me going. I have a sticky situation with people wanting me to do it on, I've got to get to a certain target before they will release. So I'm assuming then really, how do you sort of deal with that? Because if they give me, if on an agile round, if I don't get the rest, then you can't maybe make the milestones.
Yeah. So what you're talking about, some investors invest on a fill or kill basis, which is a horrible phrase, but you can understand what it means. It means you either fill your funding round or my investment gets killed. In that case, agile's a really bad fit. If you've got people who want you to meet a minimum threshold, you would typically do the minimum threshold using a price round. So, imagine one investor says, I'm going to put 50 in when you get to 100. As soon as you get to the 100, you would take the 100 and the 50, and then you could raise the other 100 or whatever it happens to be using agile after that. So you can use them in combinations, but yeah, fill or kill means you can't use agile.
Okay. So in reality, the agile round is founder friendly, but it's not investor friendly in the same way, would you say?
It kind of depends. I mean, some investors don't care about, they're happy being the first and only 50 in if you can do something meaningful. Some investors, it depends on the business. There are some businesses I wouldn't touch unless they've got every other penny. If I look at their forecast and say, well, to release a product, you need 250, there's no way I'm going to be the first 50 in because it's wasted money. So it really depends on the dynamic of the round. And I think in your case, Paul, you probably want to explain that you don't need all 150 or 250 to achieve your goal. The more the merrier, obviously, but even if you get 70K, that will meaningfully help you towards the next kind of stage.
Yep. Perfect. Thank you, Sam.
Pleasure.
Thank you very much, Paul. Andre.
Hi, Sam. Thanks for that. Just a quick one. We are EIS assured at the moment. So when you were talking about the best time to approach investors is between January and March of next year.
Yeah.
The problem is the pre-conversations to that take a long time. So, my question is, when should we be talking to investors for them to take the benefit of, the next year's tax year?
So, I mean, the answer usually is as soon as possible with a couple of caveats. So don't try talking to investors in July, August, or December. You're going to be wasting your time, and that will be horrible. I mean, if you want to warm people up so they're investing early next year, October, November are a great time. I wouldn't expect to be you might close some people, but I wouldn't expect to close a material amount. But you can absolutely start the conversations now with a view to closing, get Christmas period out of the way, hope there aren't any other shocks to the economy, and then take the money early next year. It is a bit of a feeding frenzy, from that January to April though. So, quite often we see some conversations starting in January and they'll close, by the end of the tax year, just because it's kind of use it or lose it. People don't want to lose that tax relief.
Brilliant. Just one more question. We're raising 250,000 at the moment. And we are doing minimum ticket sizes of 20,000 to a select number of investors. In your opinion, is that a right way to go? So what I'm trying to do is, I know it's very difficult for, investors, single investors, to put in, 250,000, as you were saying earlier. So what I've tried to do is give them the option of, or potential investors who don't want to take, a full £250,000 sort of risk, if you want to put it that way, but give them the option of sort of saying, well, look, there's an option to do 20,000. If you want to come in later on, then we'll give you a first option to reinvest at a later stage if we hit our targets and our milestones.
So I'm furiously looking for a graph. I'm going to share this graph. I absolutely love this anecdote. I like a good anecdote. There is a really, really good reason why I personally wouldn't set a too high minimum ticket size. And I'll show you in one graph. Let me talk through what it means. But it is, he nervously shares his screen. Hang on.
Is 20,000 a too high ticket size, minimum ticket size?
No. Yes. Sorry. I mean, yes, not no. And let me explain why using this graph. So this graph is amazing. This is, somebody did a funding round and they drew a graph of where they found all their investors, and you can see this is their company. Somebody put 10 grand in, and they introduced somebody who also put 10 grand in. So that block there is worth 20 grand. Somebody put 50, somebody put 120. You get the idea. Over here, you've got Matey, who made 2 introductions, and that all worked well. That got 55, I think, out of the total. Now look at this dude here who put just £5,000 in, but unlocked. I'm not even going to count all this lot. I'm not bright enough this time in the morning, but unlocked probably 2/3 of the funding round. If you said the minimum ticket's 10K, this dude wouldn't have invested. He wouldn't have made all these intros. You wouldn't have closed your funding round. I absolutely wouldn't rush to put, and the reason I wouldn't rush, if you're using a technology platform like FounderCatalyst or C Legals or whatever to do a funding round, adding one investor, at 5K is trivial. It doesn't cost you anything. It's a couple of button clicks and everybody wins. And not taking that Mr. 5K, this round probably wouldn't have closed without, or would have taken much longer without this set of intros. Does that make sense?
Yeah, that's really, really quite interesting. And what I'm trying to say is, you as an investor, as an example, you would prefer to sort of put in 5,000 or 10,000 at this point, rather than putting in 20,000 and see, yeah, okay.
Yeah, I mean, and there's lots of reasons people will put in less than 20K. I mean, as a good investment principle, and this has nothing to do with angel investing, it's broader than that. You want to have a diversified portfolio. So I've got 32 investments over the last 7 years, and I've done that because I don't want all my eggs in one basket.
Yeah.
If I put, if I've only got 50K tax relief and I put 50K into you, well, I'm not diversifying my portfolio. So that's a really good principle to do lots of 10K investments rather than very, very few 100K investments, for example. And also, towards the end of a tax year, it's kind of people have got money to burn, but also they haven't got their full tax relief probably. If I've already made 2 investments, I may only have 10K to put in, left in a tax relief. If you say I'm not taking less than 20K, well, I'm not going to spend over my tax relief, so I'll walk away, which is,
Yeah, good point. Very interesting. Thanks, Sam. Thanks a lot.
Pleasure.
Thank you very much, Andre. Any final questions for Sam this morning whilst we've got Sam with us? One thing from me, Sam.
Yeah.
It's good to have some good news from a founder's side.
Yeah.
The last few years have been quite barren.
Yeah.
In terms of founders seeking investment. And, how if you as a founder today with SEIS going into the particular period we're going into and all what could happen with, say, capital gains tax alone, how would you be approaching that? Just on a sort of personal level, if you was a founder.
Yeah. So
would you be announcing it? Would you be talking about the fiscal changes and how?
I don't think so. I think investors don't want founders educating them on the tax implications of their investments. I think there is a little bit of education around if they don't know about SEIS, but generally most investors were switched on to that. I think it's much more about, as I say, getting all of your ducks in a row is really, really important. If you've got time pressures on closing around by a certain deadline due to SEIS or whatever, then you may want to drop your valuation just to get the deal done, just to get the deal over line in order to persuade everybody. I think, it swings and roundabouts because a couple of years ago, actually, finding investors was really bloody difficult. There are some new tools that I would be using. So there's a company called Scribe Labs. I don't know if you know them, Ollie, but they're amazing. They've scraped Companies House of every single investor in the UK. They've enriched the data, as they call it, and which means that you've got email addresses and LinkedIn connections and thing, and you can outreach. You can say, show me every UK investor that has invested early stage in a prop tech company or whatever it happens to be, and it will show you investors vaguely interested in your segment. Now, and they also do your outreach, and it's £100 a month. So 2 years ago that wasn't available. It's just there are tools like that. You've got things like ShipShape. I know Daniel's been on a few times with Startup Standup. You've got the ways of finding and outreaching to investors is order of magnitude better than it was 2 years ago. So I think the conditions are worse, but the ways of getting in front of investors is better, if that makes sense.
Yeah. Thanks, Sam. Right. I think that's it from our audience today. If there's anything you want to follow up with, please send it over. Introductions to Sam. Stuart, did you want to ask anything at all? No? Okay. Yeah. Well, Sam, you're going to get a lot of love and a lot of big ups today on various social media platforms. And we love having you, and we'll have you back soon, I hope. And
amazing.
Yeah, and the guys at Scribe, they came in, I think it was last October, November, and they did a wonderful talk. And we tend to push a lot of people over to them to look at what they've developed there.
Yeah, those guys are brilliant, and their platform. I mean, I know they're only a small team, but every time I speak to Robert Scribe, they're like, "Yeah, we've got this new feature; it can do this amazing thing." And you're like, "It's a real," and their pricing is just so reasonable compared with any other way of finding, outreaching. It's ridiculous. So, by the way, I'm not a shareholder in Scribe. I just love their. I love everything about their business. I think it's so useful, and the price is ridiculously good.
So you can check out. Douglas has just asked a question. I think it's Scribe Labs, isn't it? And it's Rob Cousins. If you want an intro,
I'll put the link in the chat. There you go. Go hit that. It's awesome. Sorry, I'll put the link in the chat. He says, "Yeah, there you go. The link's in the chat now."